Hi everyone, my name is Jenny. Today I want to begin with a simple but important question. Should two taxpayers who suffer the same financial loss be treated differently just because one event is labeled a federal declared disaster while the other is not? Our group will be presenting on Beyond Disaster Reinstating Personal Casualty Loss Deductions. Before we begin, I'd like to introduce our team. We have Jinhan, Amy, Emily, Cedric, me, Luis, Hongfei, Danny, Maria, and Jingwen. Next slide, please. Next slides. Yeah, thank you. In this presentation, we'll first explain the problem in the current tax code, then walk through the data, discuss the policy implications, and finally present our proposed change and its impact. Now I will pass to Danny, who will briefly introduce the issue. Next slide, please.
Should the tax code treat two taxpayers who incur the same financial losses differently just because one of the events is classified as a federally declared disaster while the other is not? From 2018 to 2015, personal casualty losses are deductible only if they occur within a federally declared disaster area, a provision that applies to individual taxpayers who experience losses from federally recognized disasters immediately. This is unfair for taxpayers who sustain losses in instances like fires and other small accidents that are not covered under this law due to not getting the declaration from the president. We feel that the law should extend to those taxpayers as well, and to fund this new law, there will be a raise in the AGI floor from the original 10% by this law up to 12.5%. Now I will pass this on to the core issue and proposals.
So as stated before, the core issue with the current rule is that the tax relief depends on whether a loss happens in a federally declared disaster area, not on how serious the loss actually is. So people that lose their home or property because of accidental fires or break-ins, they receive no deduction at all, even though their financial situation might just be as severe as someone affected by what's considered an official disaster. Our proposal is simple: allow all significant personal casualty losses to be deductible regardless of how the event is classified now. To keep the system targeted and prevent misuse, the AGI floor would increase from 10 to 12.5%. This ensures support goes to people facing truly meaningful losses while treating similar hardships equally as fairly. I'll now be passing it off to Emily, who'll go over the background.
So, just to dive a little deeper into the background of our proposal, before 2018, if someone experienced a loss from something like a home fire or property damage, they could deduct it on their taxes as long as insurance didn't cover it, as Daniel mentioned. But the Tax Cuts and Jobs Act changed that from 2018 to 2025. Now these deductions only apply if the loss comes from a qualified disaster, meaning a disaster officially recognized by government authorities like the Federal Emergency Management Agency, also known as FEMA. Under Title 26, Section 139, people in federally declared disasters can also receive certain payments like necessary living or family expenses, and those aren't taxed. This change happened because federally declared disasters are easier for the IRS to verify, which helps reduce fraudulent or exaggerated claims. The downside, however, is that smaller events like neighborhood fires no longer qualified, and we'll take a closer look at how this gap affects taxpayers who fall outside that qualified disaster category.
Hello, my name is Jing Chen. I want to talk about why we need to change this tax law. It's about personal accident loss deductions from 2018 to 2025. And the big problem is unfairness. Fairness is the key to the United States test. But right now, this law only lets people deduct loss if they are in fairly disaster area. That means two people with the same loss get different treatment. For example, if the loss you suffer occurs within a fairly declared disastrous area, you may be eligible for tax relief. However, if your losses occurs outside of fairly declared disaster area, you will not receive any assistance. Worse, the persons alone decide which area are disaster zone. So some people with big salary losses get left out. That's why we need to change it. It should be fair for everyone. That is rules. Next slide.
Um, Many households experience major property losses that are often uninsured, with average damages now exceeding over $20,000. Even though these events are common and financially devastating, most taxpayers receive no deduction unless the loss occurs in a federally declared disaster area. Next slide, please. Um, the affected stakeholders are the low and middle income families, uninsured homeowners, and renters are the groups most financially exposed to sudden property losses. Communities facing rising insurance costs and even the federal government through tax policy impacts are also significantly affected by the current limitations.
To implement the change, Congress would amend Section 165 of the Internal Revenue Code to remove the federally declared disaster area requirements, while increasing the AGI floor to 12.5%. The International Revenue Service could then update its regulations, forms, and instructions to clarify that any sudden, unexpected, and unusual personal causality loss, such as fire, theft, or vandalism, may qualify for deduction if it exceeds its thresholds and is properly documented. And Burden the deduction mainly benefits low and middle income taxpayers who struggle the most with large unexpected property losses such as fires or book galleries, thereby improving vertical equity by reducing their effective tax burden. And it raised the AGI floor slightly to 12.5%, prevents abuse while still allowing taxpayers to claim deductions for truly significant losses, balancing fairness and system integrity.
From an efficiency perspective, our proposed change better aligns the tax system with its stabilizing role. By cushioning severe unforeseen losses regardless of their cause, the law would enhance the tax system's stabilizing function by helping households maintain basic consumption and preventing harmful financial coping behaviors, while also lowering the risk of abuse through incentives. Our changes refocus the tax incentive on its core purpose, mitigating genuine shocks to taxpayers' economic well-being.
I will take you through our primary funding mechanism regarding personal casualty losses. Currently, the tax law has a significant fairness gap. You can only deduct losses if you live in a federal declared disaster area. If you suffer an isolated tragedy like a house fire, you currently get zero relief. Our proposal eliminates this restriction. We want to allow all significant personal casualty losses to be deductible. To pay for this and keep the plan revenue neutral, we proceed raising the AGI floor slightly from 10% to 12.5%. Please look at the example. Under current law, the non-disaster victim in scenario B gets nothing. Under our proposal, both victims are treated equally, receiving a 12,500 deduction. This mechanism ensures fairness for genuine hardship while protecting the government's tax revenue base. Now I will pass it over to Maria to give us the conclusion.
In conclusion, revising this tax law would restore fairness and ensure that taxpayers facing similar economic losses receive consistent relief. And the current distinction, based solely on federal disaster status, creates unequal treatment for individuals with identical hardships. Expanding deductibility to all significant personal casualty losses would provide meaningful support, especially for low and middle income households with limited financial buffers. And this proposal modernizes the casualty loss deduction, reduces the risk of severe death, and strengthens the overall equity of the tax system. This reform ensures relief reaches for those who need it the most. And for key information, quotes, and evidence we use to support our tax law change, we use these sources. Thank you so much.